some people put it negatively as a choke point. Some people put it that capitalism at its best. It kind of sees the startups to the extent that follow-on investors from the Series A, only things get better. So at the Series A, what happens? An average of 166 deals, in the last few years. Interestingly, no surprises. Tech investments are 80% of this. And very interestingly, in the last 5 years, the B2C and B2B split is actually equal, right, at the Series A stage. And no surprises again, Bangalore is really at the top of this heap, and followed by NCR and followed by Mumbai. This is at the Series A stage. So, like I wanted to point out for the something that we can ask of the next panel. 2020, as soon as COVID hit, Series A came down significantly, right? And 2024, things are looking slightly better, right? So I'm just projecting from the H1 figures, but this is what it is at this point in time. No surprises of what 21 and 22 were, and 23 also, right? So I also presented the most active investors in this segment. Again, no surprises here. These are some of the names that we are all familiar with. Z47 is Matrix India Reborn. May not be as familiar, but this is the list of most active investors last 5 years. As I also said, the order is changing. Last year Axel kind of climbed, and this year Bloom is kind of that much more active in Series A. And Bloom was, as we all know, founded as a seed fund. So here are some of the other names that we're all familiar with. A good mix of international funds and homegrown funds, right? So I come to another talking point that I want to offer to the next panel. We saw the curve as far as Series A is concerned. Seed, 2020 was actually post-COVID, seed investments continue to climb, right? So, and now 2024, as Series A kind of is turning upwards, seed continues, at least the first half of the year, continue to decline. So, another talking point for the panel, what is this difference, the correlation between Series A and seed, something that we'll be interested to talk about. These are the top seed investors. Peak 15, we all know their surge program contributes significantly to that. And then the other names. Here we are seeing more homegrown funds, that much more visible in the seed segment compared to the Series A. This is a chart that again I find interesting. How successful are seed investors in graduating their portfolio companies to the Series A? And we've kind of broken that down year on year. So when some kind of interesting insights are coming up, even as you see the breakdown, some of them in 23 are doing much better. Bloom, for example, is almost uniform, 7, 7, 7, 6 and 8, between 2019. Their portfolio companies getting onto Series A stage. And the last slide is the funnel. This shows how successful or otherwise from startups, 4,000 startups that we took in the 2015 to 2023 period, gave them at least 18 months to graduate to the next levels, and then see how the success ratio in getting the follow-on funding is. It's only 25% at the seed to Series A, and this reflects very well even with anecdotal experience from a lot of investors. But then the success ratio improves quite significantly from each stage to another, right? So Series A is 41%, Series B to C is 45%, and Series B onwards, C onwards is 47%. Now, this is obviously a lens looking backwards. The current funding winter, including the stuff that's happening at the growth stages, is probably going to get captured in the next year's, numbers as such. But this is as it stands in end of 23. So we will know better, and I'm sure, the panel that will follow has that crystal ball, and they do this day in and day out. So I'll stop here. Thank you very much. Anybody who wants to download this report, QR code is here, as well as outside on the banner, and you can download it. Thank you very much, and I look forward to the next panel.
We will now begin with our next panel, Focus on Venture Capital. We welcome on stage for the panel Manish Gupta, Partner Shardul Amachan and Mangal Das, Arjun Rao, Partner Special Invest, Naganand Dureswamy, Managing Partner and Founder, Idea Spring Capital, Chino Senthil Kumar, Managing Partner, Xfinity Venture Partners. Manish Singhal, Founding Partner, Pi Ventures. Archana Hingorani, Co-founder and Managing Partner, Siana Capital. Action in various sectors. He has also represented clients in various joint ventures, acquisitions, divestments, business transfers, financial and strategic investments and exits. Corporate and business restructuring include for dispute settlement, general corporate advisory, etc. Over to the panel.
Good afternoon, everyone. I think before we start our panel, I'll request each of the panelists to introduce themselves.
Hello. I am Archana Hingorani. I've been in the PVC space since '95. In 2019, I started my own fund management group. It's called Siana Capital. We're focused on deep tech, both science and technology. And I'm also a professor at the University of Pittsburgh Graduate School of Business.
Good afternoon, everybody. I'm Arjun Raus, partner at Special Invest. We're an early stage venture capital firm investing in deep tech ideas in the pre-seed, seed stage. I've been doing this for about 7 years. I was an entrepreneur before this for another 8 to 9 years, and been in the startup tech ecosystem now for close to 25 years. Good to be here.
Hi, good afternoon. My name is Chino Senthil Kumar. I am actually managing partner at Xfinity. And I have been in the VC space for about 10 years. And we focus on B2B and deep tech. And I think many of us are here focused on deep tech. And we have launched 3 funds. We are going to be launching our 4th fund actually. We'll talk more about it.
I'm Manish Singhal. I run a fund called Pi Ventures. We only do deep tech. Been in the business for almost now 7-8 years. Background is in technology. We've been in several technology companies and done some startups before this.
Hi, Naganan. I run a fund called Spin Capital, similar to others, early stage products, built in India, selling to global. Been an entrepreneur before, 3 startups before, been in the fund business for 8 years now.
Thank you so much, everyone. I think we should thank the panelists to spare some time on coming here and sharing their views. So now coming to the topic is venture capital in focus. Maybe I'll start with a topic which has been commonly spoken about generally in media as well as today in this conclave, in the previous panels, which is the funding winter. But maybe we'll just tweak it and ask some interesting aspects of that funding winter from our panelists. We saw 2020 when the COVID came, everything dropped in the first half of 2020, but it was followed by the active activity which has started, and I think I don't need to talk about that, how frequent and how much deployment, how much dumping of capital was there in India. Things started slowing down, I would say, post in the second half of 2022, and after that we have been hearing multiple phrases, funding winter, etc., etc. But now we are at a stage where we are seeing a new sunshine coming out, and at that level, I just want to request my panelists, I'll start with you, Archana and Manish, to share your thoughts, your views, maybe with what really brought that funding winter. Was it because of the exuberance which was prevailing in the last 2 COVID years? Was it because of the beating tech companies had in the US market? Was it something else, the crazy valuation, flopiness in the system? So what really led to this funding winter? how did it impact the ecosystem, particularly in the Indian context, in the context of, from the founder perspective, when they are looking to raise funds from you, from your perspective when you are raising funds from your LPs, and what is the current status, and like where do you see the way forward?
So many questions. So, I would just say that, there are cycles in any case. When they're up, there is an explanation. When they're down, there's an explanation. You're right that, after the 6 months of everybody hiding post-COVID, not knowing whether you're dead or alive, suddenly everybody was like, okay, we are alive, let's go do some deals, right? So you saw a lot of activity. And then one fine day, everybody's talking funding winter. In my head, it's a combination of a lot of things. It may be valuations, it would be the cyclicality, but I think the trigger point, at least my understanding and the way I'm seeing it, is that it was the Fed deciding to increase the rate, right? That was the trigger point. That doesn't mean that the people were not thinking about it, but I think that sort of made the segue into saying it was okay to say suddenly that we don't want to fund any longer. Of course, it had huge implications, I think, for everybody. I'm not so much for C like I mentioned, but I think A, B, C got significantly. I think B and C got significantly impacted because suddenly the same guys who were investing with you and asking you for growth were demanding EBITDA and PAT positive. Where are you on that, right? So there's a complete shift that has happened in the last 1.5 years, which has really led to, I think, recalibration of even business plans, which is not, it's a good thing, but to suddenly, overnight tell somebody, look, I was looking at top line and I also wanted to focus on bottom line, is a shift for the entrepreneur. It's a shift for us, but it's a much larger shift for the entrepreneur, and it takes some time to recalibrate. So I know you said that there has been some fund, Series A, etc. has gotten funded less. I think Series B and Series C have suffered equally, in my opinion, because some portfolio companies of ours would be looking towards that from all our portfolios, and at least I can see that it's not been that easy to convince people to come into the next round until and unless you are on that path to EBITDA, so to speak. Yeah.
I think whether it's winter, summer, etc. depends upon what stage and what thesis you have. So at least as a seed stage deep tech investor, we believe we live in the equator. All 24 months are same. There's no winter, there's no summers. We are doing as many deals as we were doing before. So there has been no change for us. But in the consumer, I would say in SaaS place, SaaS was a big thesis a few years back. Now everybody does SaaS. SaaS, I don't know what will happen, whether it will have any SaaS left after some time. There has been a shift in the later stage funding, I feel, Series A+. In my opinion, it's a good thing. For whatever reason it has triggered, because the bar for merit has gone up. So at least what we have seen in our portfolio, if the company is doing well, and when I say well, let's say they're hitting 50-60% of what they should be hitting. We've not had a problem in them raising a follow-on round. But if you're not doing well, and then also you're raising a round, then where is the value for merit, right? So I do believe that the slowdown in later rounds is actually good for the ecosystem. It is making survival for the fittest in some sense. Companies which are strong, they can move forward more strongly. So yeah, that's what I feel. In seed stage deep tech, we are not seeing any change.
I think you want to share some views.
So I think everything is cycles, right, the way I see it. It doesn't matter what, things go up, things come down, right? And you will see, I've seen 5 cycles in my professional career, right? Starting with the dot-com bust, then you had the housing crisis, and after the telecom bust in the US, and then the housing crisis, then COVID. So something will happen. Every 6-7 years something has happened, and I think everybody has to be prepared for it. In this particular case, if I were to add one more thing that kind of messed up the market economics in startup space, is too much easy money. Because there's 0% interest anywhere, right? And government gave away a lot of free money. Everybody had free money and 0% interest anywhere you go. What are you going to do? You have to put the money somewhere. The money had to be deployed. Now go ask people to give easy money when the banks are giving you 6-7%, you will not get it anywhere. I think there were some global things that happened in the US across the world post-COVID. The other thing, I was looking at Arun's graph. Post-COVID, SaaS became a craze because everybody for the rest of your life you'll be working from home. And hence you need this product, that product, now I saw Amazon, that Amazon is saying come Jan 2nd, everybody comes to office 5 days a week. So I think the correction will happen. And there was this irrational exuberance, I think is the right term to use in this particular case because it just went bonkers. How can software companies, you are making 1 million revenue and you're valuing a company at 100 million. And then now you're catching it. All the previous bad karma is catching up. So that's why the next round is kind of getting screwed. There's no justification. Market is valuing you at, you go to market, you're valued at 15x, 10 to 15x of your revenue tops. How can you justify 100x? So I think a lot of leverage has happened. There's a strong blip, but I think they're used to it, right? You would assume people would learn, but I don't, human beings have very short term. So I think that's the core of the problem.
But do you think that this, whatever you call it, as a funding winter, it impacted one particular segment or the stage of investments than the other? Was it the growth stage which impacted a lot as opposed to the early stage where you guys really are involved?
Manish's point, early stage, there is not much headroom to grow, right? Early stage, because all the big guys who have lots of money, they're not going to play the early stage game. So only guys like us who have very little money we play, and we are niggardly by nature, because we don't have much money to give. So I think the market basically, it levels itself at the early stage. Because guys with a lot of money are not playing this game. So guys with little money, like early stage fund like us, will play that game. And we don't have a whole lot of capital to deploy. So we'll kind of naturally bring it down. But as you go higher up, the stakes get higher. Funds. Where would you initially saying VC funds would be $1 billion funds was unheard of, and that's private equity play. I think we all got confused. Whether you're playing VC game or private equity game. How can somebody invest hundreds of millions of dollars and call themselves VC? I think they should call themselves private equity guys. Where you go IPO, early stage companies. If you're saying I'm going to invest $100 million, I don't know where the returns are going to come from, right? So there's a lot of imbalance. So I was talking to a lot of people in the US also on this, right? They're saying VCs who have been in the business for a long time, we are having a tough time understanding where are you going to deploy $3 billion. Fundamentally, things went all over the place. So I think we'll see how things. I don't have any prediction, but I can only look behind. I don't know what's going to come.
Yeah, that's true. You made an interesting point that the VCs were investing much more money than what was expected out of VC. And the difference between VC and PE was getting blurred. Because on the contrary, we have also seen that the PEs are coming in an early stage, like a Series A, when earlier they used to be at a Series B or Series D or Series E. They also started coming in because they realized that VCs have started coming in, taking a bigger pie on the cap table, and there is very little left for them when they come in. So that also happened. But if any one of you wants to share your views in terms of how it impacted the overall environment, impacted your fundraising from LPs?
I'll take this one. I think overall, there has been an impact. You cannot deny that, though it has been in B2C, B2B, because the late stage definitely suffered. But I think the good thing is it's almost getting over for the last 2 years actually, right? Because the churning was going on for the last 2 years. Many late stage companies, Series B and above, they had really difficulties in raising money. They had to take a huge haircut. So it is not just in India, US, you go to Mexico, different parts of the world. Many of them had to go through this problem. Some in the process died, unfortunately, and whoever stayed on to live, they have taken a huge haircut. Like Manish was talking about, whoever maintained fundamentals, they were able to even raise with slight upround. It happened also. I think the moral of the story is that this cycle will keep happening every 5 to 10 years, be it in public market or private market. And I think, in my opinion, in addition to the Fed, I think COVID triggered all these things because money was available like crazy. I don't know whether you will see this kind of trend again. Actually, it will happen. It may not be to this quantum actually, and I think that placed everyone in a crazy state. And just to give an example, we raised our third fund in 2020. We did not invest in 2020, 2021. 2022, we started investing in the second half. And we have invested about 16, 17 companies now in our Fund 3. Most of the investment happened from 2022 second half and 23. But I'll tell you the other pressure we had. Most of our LPs, they came and asked, are you doing something correct? What is wrong with you? Everybody else is investing. Why are you sitting on the money? Okay? It was a conscious decision, and but that was the pressure VCs also. And I think Anand told, like the PEs were getting into VC landscape, and probably the VCs were also getting into everywhere. So it was like a little bit of a confused state. But I think things are good. I think only after confusion, clarity comes actually. I think from Indian VC ecosystem, this is the first time. So probably that's why everyone feels in a big way. But I think people who have seen this cycle, I think it was not completely unexpected, but the quantum is very big. That's the way I look at it.
I think one of the experiences on our LP side was very strong, tough questions on which sector, why are you doing this, right? I think Naganan mentioned this, and this was true for us within our portfolio. LPs definitely asked us in the last 2 3 years, why are you doing SaaS, right? Do you really have a right to win? Are you really going to find those SaaS companies that are going to be multi-bagger outcomes? Because you see what the public market multiples are in SaaS now, right? I think it's possibly at 8 to 12x, right? So if you're investing in entry point valuations, possibly haven't really changed, right, from the peak, right? Maybe they went about 25 million for the first pre-seed seed check, correct? But we're still seeing founders expecting and some fair few rounds happening at 15 million at an idea stage, right? Because there is seed capital available either from small funds or from larger funds. Now, when you start off a company at 15 million valuation at idea, right, then they'll go from there, get to 1 million in revenue, which itself is not easy to do. It takes some time, and then 2 million, 5 million, etc. And at 5 million, if you get 10x multiple, that's a $50 million company. If you take going from 15 to 3x, so that question of sector focus became very, very important. Was questioned, consistently asked by our LPs. I think we also had the benefit in our case of showcasing the deep tech side clearly, which was differentiated, which was unique, which actually did not benefit in a way of the 2020 and 21 wave, right? Because it was such a new sector, or it felt like a complex sector, because nobody was investing in hardware, right? So we did not see the high, right? So when things were down in the low, we were still in the medium, right? So deep tech was sort of our savior, if you will. SaaS was very strong questions asked by LPs.
Okay, maybe let me ask a question which can be slightly sensitive, because I take your point that in maybe deep tech in an early stage it did not really impact. But maybe the portfolio companies which you have, and those were now looking for a Series A or a Series B round, and yes, they are struggling there because of a lack of interest or this so-called funding winter. And then the founders are really looking up to you to help you either in getting the money or do a follow-on round or a top-up round. So, and at the same time, maybe it is your fund philosophy or your fund documentation which don't really allow you to put a lot of money unless there is a third-party investor coming in and doing the price discovery. How have you handled those situations? Because these are equally tough questions from the founders, and they're really looking up to you.
So maybe I can start. So if we put the portfolio broadly in 3 buckets, A, B, C. A is companies which are doing really well. They pick their stuff. At least we have not seen a struggle. It may have taken longer, may not be at that much crazy multiples, but they were able to raise money and there is no problem. C are companies which were really in the red. So maybe if too much capital was available, they would have raised, and some of them died, and some of them sort of collapsed. It's the B set of companies which was in the middle, right? A land of living dead, if you will. So those companies had the toughest time. In those companies, I think in our portfolio at least, some of them didn't close down. But what we saw in terms of, instead of proper rounds, a lot of bridges came in. So you raise some bridge, you survive to live another day, etc. So that is something that we saw in our portfolio at least.
I'll just add on a little bit to that. Definitely, I think that middle segment is the dodgy one. Tough decisions to make for us as GPs. One thing that came to the fore that much more was co-investor partnerships. Right? If there's more than one investor on that board, right, then you can collectively take a decision, right, that both of us feel confident, 2 of us or 3 of us, we feel confident about the future of this company despite a little bit of that rocky road, if you will, right? And then that bridge is split a little bit, which is sort of risk mitigation is one way to do it, right? And yeah, if collectively you don't come, then it's hard, right? You will make some tough choices. I have 5 options, I'm going to only do in 1 or 2. And you will pick your sort of favorites in some sense. The other thing is, of course, forced discipline for these companies to somehow stretch themselves longer, right? Can we get to the other side? Maybe there's a little bit of a saving grace next year, 6 months down the line, right? Some companies have done services to survive, right? While they were product companies. So people have done all sorts of things to survive. Some have survived, some haven't survived. But I think the reality check is the most important, right? What is even there ahead was sort of for the longest time not clear. Particularly the first time founders, we worked with, we heard a lot of, hey, 6 months later that time will come back, right? They were in that mode that this is a blip. They didn't realize that heady times were the blip, right? And they thought that times will change. So,
we've been told about this. Just wait for it to get over.
Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts.
I thought you told them it's not interesting, just do that.
Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use
I
the
don't have any idea
lifts.
how long it will take.
I hope it doesn't go on to the next hour.
Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave. Nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. The nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency, it is necessary to evacuate the building. Please leave by the nearest exit. Do not use the lifts. Attention please. Due to an emergency,
Thank you so much for not leaving the room despite so many reminders to you. So applause from the panels, from all the panelists for that. So maybe Arjun, you were saying something, but maybe if you want to continue with that, or maybe we can move to the.
Yeah, I think I think we were just trying to see if the mindset itself of what to expect was really tough, right? We had to pick winners in the portfolio, etc. But I think we saw extreme sides, right? One set of founders said, "Hey, good times will come quickly," right? This is just a luck. Some others really took all the advice in the ecosystem very strongly, and even today, when we are sort of on a recovery path, for example, I was speaking to a founder and they were saying, "I want to be default alive," and this is at seed stage, right? Where growth is still important, right? Where you want to find PMF and then you want to show reasonably fast growth, but they are in the mindset that, I will never get capital, it's going to be so hard, so I should be default alive or I should break even now. I said, there's no point of breaking even at $500,000 in revenue, right? So I think conflicting messages across the boards are very difficult to rationalize and come. So we have to do some correction there. Those were the experiences.
The only thing I would add is it's not an instantaneous decision, right? Because you talk about the next one when you invest now. It's a long journey. There's no surprises. So it's like you're going through the journey, and then every month you're saying what's happening, what is funding, not funding, where can we raise capital, whom do we go to? So it is kind of dampened. It's not like okay, you want to raise money, no, we give money or we don't give money. So that way it's more of a continuous journey rather than there's no impulse there.
I think you touched upon the next topic which I just wanted to raise, because funding retail was just not, or has not been just lack of money, but is also about the valuations. And we have seen the early signs of that when India was producing unicorn, like one unicorn every month or every week. At that point of time, in that race to become a unicorn, the people have adopted a strategy to mix a primary and secondary round to average out the valuations and the price just to get the unicorn tag. That has also happened. And that was the early sign that, yes, there is something wrong. The valuation which you are really claiming out in the market is not the real valuation, even for that one. And after that, we have seen a real consequence of that a lot of companies which raised money at that valuation, they were struggling very, very hard to get more money. Either they had the money and they were playing on that runway, or they had to do a flat round or a down round, and we have seen that across all growth stage companies. Either they waited or they did the down round, or they just did the flat round and on the backside they did the secondary to give the lower valuation to the investors. Having said that, so this lower down rounds, lowering the valuation is something which also impacted at your level when you are assessing deals, that because the kind of valuations which the founders were seeking earlier, that has changed, whether there is any other parameter which has really come on the forefront while you are assessing the deals. Senthil, Chino, I know that you did not like invest during that period, but was it a conscious call, or there is any correlation of that with this?
Yeah, actually, just to repeat, in our Fund 3, 2020, 2021, we did one or two investments. We have done so far 16 investments in Fund 3. Bulk of the investments happened only in 22 second half and 23. So about roughly 13, 14 investments. And the reason we felt this is like crazy market, okay? And I'll give you one example. There was a particular entrepreneur who came to us, and I'm probably talking about 2021 end actually. And he told us that I already have raised so and so much money, and I have left 3 million left to be raised. And the last valuation was like 30 or something like that. Just that was like a few weeks before, not far away. At a valuation of 30. For you, for us, Xfinity, we are allocating 2 million at a valuation of 45. And the rest of the 1 million is going to go and give it to some other VC or some other investor at a valuation of 75. And we had all the IC, everything was set up. We liked the company, we liked the the vision and everything. Then we suddenly became, because this came after we set up the IC meeting. Actually, we called up the IC meeting. We said it will not work for us actually. And it was a little bitter, but I think, we had to call up the meeting because there was no way we could adjust to this expectation. There were moments like that. Okay? So I think, there were many crazy expectations. There was many crazy valuations also happened by the investors. We had to admit that. But I think as a result of all of those things, I'll tell you there is one more incident. This is related to one of our portfolio companies. I will not be able to share. This is a US company. So they raised Series B at a valuation of 180, about 2021 or something like that. They are actually in discussion with a strategic investor. They are raising about 75 million valuation, Series C. And there is a discussion, which is an upfront. It's an upfront. So good thing is it's upfront. But the founder himself, he does not want more valuation because he knows that when he goes for next round or exit or something like that, he will not be able to justify the valuation. So that is the level of thinking change in the entrepreneur ecosystem actually. So I think there has been a correction at the investor level, in the entrepreneur's level, and there has been a clear correction. The expectation of the valuation has gone through a massive correction actually. I think it has come to rationalization, that's what I would say.
So in my opinion, one of the worst things that has happened to our industry is unicorn name, right? Because it's stupid. I don't get it, right? What are we chasing? For what reasons? Nobody knows. Everybody in India, we are saying we're producing one unicorn every month, every week. Raise $400 million at some valuation. You make, let's say my revenue is 400 million, but I'm spending 800 million. I don't know. Man just doesn't add up anywhere. It's foolish, right? It's absolutely insane. So, now everybody has stopped talking about unicorns. Right? You don't even see the term. Right? Yeah,
it has changed to Sunicorns now.
Whatever. It's like all this corn will give you corn at the end of the day, right? If you don't build a tree. So I think we should just stop all this nonsense and then go after companies that are building something and making revenues and then keeping some money for cash in the company. It's just saying I'll burn and someday it will work till some point of time. But that's very hard. Yeah. There are only few companies that can succeed with that kind of a business model. There will be some success. I'm not going to say like Uber is successful. Over a period of time they burned a lot of money. And Swiggy, there are some successes, but there will be so much money will be spent to build so few companies. It's not funny. Right? So I think we lost. Not only in India, all over the world. Everybody is changing the wrong term. So that to me, I was always irritated with this term. So.
You want to add something?
I just want to say that already this point is covered, but I think there has been a shift in how entrepreneurs are looking at the money and the value of money. That there has been a shift. How do they spend money? How do they think about valuations? And therefore, I feel that it is good for the ecosystem.
Maybe let's move away a bit from this funding winter and let's talk about exits also. Because it's really important as for you guys to put in money, that is important, and to ensure that you exit at the right time at the right value is equally important. So how has been your experience, especially in the deep tech sectors, with this complete up and down in the market which has happened? There was a complete exuberance and then the funding winter. So how has been your experience? Because what we generally see, what we generally hear is that India has done really well on the exit front. And the exit story is something which they are able to sell. When they are raising funds, the IPOs have been successful, there have been also other modes of exit. So what has been your experience? Maybe let's start with your Shana.
But on the opposite side. Of course, there have been a lot of stories coming out of India about exits. There are strategics, there are long-term players, the ecosystem much deeper. But I'd say in our space, it is still, very much, there are not that many stories that you can consistently say that, okay, the market is deep enough. A, it is not deep enough. B, even if you have a particular strategy, I'm not sure there is, let's say you want to do, a secondary. You'll find in our market suddenly, even if the company's actually done decently, to Manish's point, they do well. You'll find people talking about, okay, what is the lowest value I can pay for, right? Rather than saying, so there is no ecosystem for a fair valuation. At least I'm not seeing that. So until and unless that doesn't get developed, all of these, funds in the next 4 or 5 years, whenever they come out, it's going to be tough to be able to prove that you put in so much effort. You can see it also. It's not like you can't. But even if it is EBITDA positive, PAT positive, people are like, no, it's too expensive now. We need to. But the problem is it's one guy. What happens is that people standing there's only one guy standing there. As versus, when new rounds are happening, there are at least 5-6 people, some PE guys competing with you, some VC guy competing with PE. There are enough entry point people, right? But when it comes to exit points, you don't have the same level of maturity, and probably rightfully so, the VC market is not as deep. But nonetheless, I see that to be the biggest challenge as far as I can tell.
Again, going back to the ABC model, A companies we've had exits, legal paperwork, etc. took forever. I blame the lawyers for that. But the deal was there, right? We didn't have to struggle for the deals. B and C companies are impossible to get any exit out of it. Very difficult. So in a couple of cases, we took some money out, and literally just sort of so that the loop can close. But B and C very hard. And it doesn't matter whether it's deep tech or not. I feel it is true for.
It's not about the sector.
Yeah.
I'm only going to possibly say that maybe we have to, live with this, right? It's the reality. There aren't enough buyers, right? There is secondary interest now, right? Why? Because there is so much, supply, if you will, right? Where all of us and others, we need liquidity. That's the reality, right? If you've been a fund that has been around for 7 years, 8 years, anything about 6-7 years, then that time has come, right? You need some liquidity. And when you go out in the market, then that's right. What is true is in certain newer sectors, we've not, the lack of depth helps the buyer because, pricing power is there on that side. But as we get through this first cycle, if you will, right, and we get liquidity, and we also, at least in my case, we can say that we're a young fund doing this for the first time, the fund one is coming to, right? A liquidity cycle itself is a learning experience. Who to sell to, how to negotiate that discount, whether somebody asks for a 50% discount and then you try to get to it at 30% or 20%, but you get liquidity for your LPs, it goes back and helps come back again. And it also teaches you, when you want to set your companies up to be in a better position for some leverage and negotiation. So I think it's that first cycle is one way of playing out, and I think secondaries in general, I think we've heard so much about secondaries in the last 12 months. Right? New secondary funds have popped up, new vehicles have popped up. It's just a whole new class because there's available for certain discounts. I think I was at a secondary conference, some others also might have been here and saying, hey, we should all be only that average price will be 40% discount. Right? It's scary, whether it's a fair price or not, I don't know. But liquidity is just that much valuable. So I don't know. Maybe we have to suck it up.
One thing, exit definitely when you go for fundraising, people compare India exit to be a challenging. They often try to compare with China or different markets. I think the exits come in three ways. One is the growth stage secondary or PE funds. The second one is, I think off late, we have to see how it is going to unfold. Under $5 billion, the IPO market seems to be interesting in India. Whether it is going to sustain, that is yet to be seen. But at this moment, there are companies which are thinking about flipping back to India. There are a few companies thinking about that. And third, actually, if it is a deep tech company, say if they exit, the overall company exit value itself is like say 250 to 500 million. The strategic acquisition is a possibility. Because I think if you look at the scheme of things, let's say if there is a Fortune 500 company with a $20 billion revenue, under 500 million, they don't need to go through a lot of paperwork to acquire a company, unlike if it crosses certain threshold. So if your company is exiting at that kind of valuation, 250 to 500, that's a sweet spot. So I think you have to pursue multiple options. I think early stage funds like all of us, we need to spend significant amount of time in the exit story. That's the reality today. And there are some companies like Manish was talking about, get multiple buyers. In some cases where we have to proactively go and talk to people, either for this strategic buyouts and everything. But I think one area which we have done, we actually experimented. We do a partial exit in multiple companies rather than waiting for the full valuation. I know that you probably lose out at the valuation. Let's say if a company has the potential to reach out to like say 750 million or a billion, you start exiting because we typically invest like a 25 million, that kind of range valuation. So you start exiting once it gets like 10x. So that way the pressure is off. Also you demonstrate these companies are, basically there is a liquid option actually. So I think there are multiple things you have to pursue. But my reading is actually after seeing like this idea forge IPO, there is momentum is building actually, but we have some distance to cover actually. I don't think we can expect the exit to happen from India market alone. It has to be a combination of many things, and I think fortunately or unfortunately, VCs like us, we have to spend a lot of time on the exit side actually.
So we hear about the top line news about the listing of the companies and the reverse flip, etc., etc. But I think that is a very small portion of the entire ecosystem. The listings have obviously of the startup companies, tech companies have increased, no doubt about that. But I don't think that we can say that as a common phenomena as an exit route for the startup companies in India. They are far and few. The numbers have definitely increased, no doubt about that. I think what I feel, what Archana was also trying to alluding to, that mid-market exit where you are in that range of 200 billion, 300 billion, and then the buyers are far and few, and then the buyer really dictates the exit. So, what has been your experience, or what are your real views in terms of how that particular missing piece can be plugged in the Indian startup ecosystem? Because the companies which are crossing 500 billion, either in terms of revenue, etc., they will get either buyers or a long-term investors. You can get a secondary exit or an IPO. But the companies which are in that middle market, what are your views? How the Indian ecosystem can come up with really a mechanism which can give exit to early stage investors like this?
So I think the way I look at it is, see, companies which are in the value, if I understand, 200 to 500 million range, that actually you cannot go for IPO. And I don't think the Indian corporates, they are buying companies of that kind. That happens a lot in US, and I don't see any option at this point unless you go for a growth stage, because US it happens. Like if you look at big companies, they are very keen to pick up companies 250 to 500 million valuation, which is very strategic from their point of view. In fact, I know few companies they don't want to go beyond 500 million valuation because the paperwork and the approval, board approval, everything is huge. So they prefer companies to be acquired under 500 million valuation. I think that kind of trend has not started, and also I think the deep pockets are not there in the corporate world in India to pick up 200 to 500 million valuation. So it has to come from outside, or PE investment or growth stage, and obviously that is not ready for IPO either. So I think I don't see any option unless somebody else feels that there is an option actually. Well, maybe if there are secondary funds which are being set up, there are some secondary funds which are coming with the purpose of acquiring only secondary funds. Maybe that could be an option actually. Actually, that's a lucrative option right now.
So if you look at it, right, I mean, we're all claiming that and we are investing in deep tech, but I'm concerned about the existing deep tech, to be honest, because first of all, there's no market in India. Only now we are saying defense will buy, so we are all getting excited saying there's a market. Otherwise, zero market, let's be honest. If you get to $10 trillion economy, there's nothing happening here in terms of, so you have to go outside. Selling deep tech products outside of India is an extremely hard proposition, right? So we are all experimenting and hoping that we'll figure out means and ways of selling the product that we build here in the US market or outside. And I think US predominantly because I don't think we have the capability to sell to Europe unless until it's a very specific satellite or space, because Europe is, each country is selling differently. So all our companies, they say go to US. So we try and go to Europe, we get backed. Every country is different, laws are different, marketing is different. For example, we have a startup that's trying to sell in France. They say, no, I will not take any US marketing because our thought process on marketing is very different. So you redo all the marketing material in French. Just doesn't work, number one. Number two, what we have all invested in typically is product companies, software, right? So software is easy to scale and easy to sell from here. So there will be buyers because, Google once said, right, why do we buy companies? It's either one, either because they have some tech that we don't have. And what's the probability that we'll have a tech that Google doesn't have? Fairly low, let's be honest. Or we say because they have so many customers that we want to acquire customers. That also is hard. So intrinsically, what it comes down to is what we have to offer. Generally, US companies don't find it very beneficial because it has to hit one of these two things. Either they don't have the product or tech, or we have so many customers that they become interested in. In India, if you look at it, I think in my mind at least, other people can, and only 3 companies in software space have made it, right? Freshworks, Soho, Tally. Tell me one company, software company, product company. Services, we have tons. But services guys even today have although they say we want to offer product, it is just so goddamn impossible to even get them to sell our product companies along with their sales. Because we will go and say how much are you going to sell our product for? We'll say 25K, 50K. Their deal sizes are 5 million, 10 million. I say it's not making any difference. I have to incur more headaches to sell your product and nobody sells. So that is the fundamental problem in exits. And currently IPO market is hot. Yeah, we might. But I don't think this IPO market will continue like this for another, for next 1 year is what people are predicting. It comes down. So I think if something keeps me awake in the night, it's always exit, because you will find deals. There's always sucker to give you capital. You figure out, beg, borrow. You will get some capital. You will also figure out a way to grow the company. But to Archana's point, when it comes to exit, I think that is still to be tested. I don't know. In India, I've talked to many LPs also in US. They're not happy with India returns, by the way. They are saying now we are going to back off from India. We want to see some exits happen. And then once we see that, then we'll get interested in it. The mindset in the US today for LPs to invest in Indian funds is not very good, honestly. So I think we have to be concerned about this.
I think one, adapting to this situation, which is tricky for all of us, which is we're all concurring on that, it's tricky, outcomes where they are at what scale is hard, right? Is actually one stage before. Right? When a company is between $10 to $25 million in revenue, right? It's a key fork in the road. Do you want to raise more money? Right? Or do you want to sell then? Right? If there is a clear path of amazing momentum and the product really differentiating itself and possibly being among the top 3 products in that category, right? Which is the only way it will go from that range to $100 million revenue. And after $100 million revenue, you can imagine hopefully multiple options. Even there might be some bumps along the road, but relatively lesser. Correct? You can at least IPO plus, right? So maybe the question to ask is, what do you do between 10 million and 25 million revenue, right? And at least for early stage investors, it might be that can be a pragmatic approach. That this is the time to exit, because if you feel that you're not going to go from 25 to 50 to 75 to 100 million, then don't take more money. Then don't raise more capital, don't dilute further, and then the burden is just that much higher, right? And somewhere along the way, if your acceleration goes down, right, or rate of growth goes down, then options, the doors just keep closing as opposed to opening, right? So I think first of all, even today, forget the $100 million revenue companies. It's not like we have 100 companies with 25 million revenue, if I'm not mistaken. Correct? So if we hit 25 million revenue, or anywhere in my opinion between 15 to 25 million revenue, there has to be proactive thinking from the board, promoters and investors alike to say, what can we get the best outcome at this stage, right? And at that time, you can package it well, because that's liquidity back into the cycle, go out and do something else, right? Of course, maybe 5%, 10% of those can hit escape velocity and then go to 100 million and then well above, right? But the question has to be asked at the 20 million revenue stage.
Just to add to one comment, so when I say companies which are setting yourself for global acquisition, see, at least the companies we have, they are US headquarters with development or one founder here. So we have taken the choice because of all the reasons you talked about actually. Because I think there has been a change in the landscape. 5 to 7 years back, if a company is domiciled in India, deep tech, if you are trying to sell outside, the global customers were not comfortable, no matter how deep tech it was. That was 5 to 7 years back. So in those cases, we had companies where we invested, US-India corridor or Singapore-India corridor, the headquarters is in US, maybe one founder is there, or at least the contracts are done through US or Singapore actually. But I think of late, I can give one example. We have a company called Aviros, which is founded by a Carnegie Mellon PhD. And this guy came back after his PhD and he started a company called Aviros actually. So to our surprise, he was selling his products in India, like to Honeywell India and NEC India. Recently, he got an order in a global tendering in Pratt & Whitney, which is a US company actually, in a global tender. I think there has been a shift happening even in the US global ecosystem because of many geopolitical this US-China conflict. And in fact, there was one corporate venture VC who came to India very recently. They shut down their VC office in Israel, also in China. They are going to invest in India. So there has been a shift happening. But having said that, if you want your company to be setting yourself for acquisition, 250 to 500 million valuation, first of all, you need to have global customer. In many cases, they prefer to deal with either a Singapore company or US company. Maybe down the road, they may find comfort to dealing with a company directly in India, because that's the pattern we are seeing it. So we are seeing how it is evolving.
I think there's another trend because of this exit thing. Even if you get an exit, in the real terms, the exit had subsided because of the exchange rate, INR dollars. That also take a cut out of the returns you make. That is also an important factor. And that is the reason when the deep tech company, when they go to US, they reflect or they establish there, and then they do the exit from there. So I'm cognizant about the time. Maybe I'll just put the last question. And I think that is also something which is very hotly discussed these days about the corporate governance. And that has been really come up in the forefront in the last 1 to 2 years, I would say. So have you seen, or are you also working with your startup companies, your portfolio companies to establish some level of corporate governance just beyond compliance? Compliance is one thing, but more than that. And what has been the reaction of the founders? Because maybe at a very early stage, this may be too much of an ask from this.
It is actually, but I think it helped us definitely. Be it in due diligence process, we generally took longer time. It runs, we have probably done more than what was expected in the system, and it took longer for close a deal. We approve in the IC, give a go, no go. After that, we take another couple of months to do quite a bit of diligence. We talk to the founders, we take recommendations, we go through the classical due diligence actually, though it is an early stage. and I think it was not that appreciated, to be frank. The reason is because the time involved, and they see the entrepreneurs see the other VCs, some of them they don't go through that. But I think in hindsight it helped actually. That's the way I would look at it. And I think it goes case by case. We rejected some companies also after we have given an in-principle approval based on certain material evidence actually. But I think from an early stage, it's a very time-consuming thing. And plus, I think you have to put a lot of resource and material. That basically takes away your time to do many deals and do other things actually. That is one. And in terms of corporate governance, I think the ecosystem is also evolving. I think if I look at 10 years back and today, I think the entrepreneurs are more mature. They understand the requirements, and they see the value of corporate governance, setup and everything actually. So I think, the entrepreneurs, to give a lot of credit to the entrepreneurs, they are also evolving and they are appreciating actually. But I think generally these topics, it's you have to do it with the right amount actually. If you overdo it, it may not be good. You have to feel the pulse and do it in the right amount actually. But it is definitely required, and I think as an early stage, we see you have the responsibility to set the culture actually in terms of spending, the decision-making process. But I think you should not do it for the process sake actually. It should not look like a ritual. As long as you are able to explain the value and benefit out of that, I think entrepreneurs understand it.
Anybody wants to add to that, please? Otherwise, we can ask our audience to ask questions. You can just introduce yourself and then ask the question.
My name is Shrikar. I run a medical device startup. Because all of you invest in deep tech companies, healthcare is a much bigger part of it. So I just wanted to understand from each of you, how do you see medical devices as part of your portfolio? How do you really see, because it's quite evolving space, I just wanted to get your perspective on that particular market. Thank you.
Yeah, so as you said, health is anyway a big component of any portfolio. Even if it's deep tech, you do end up looking at it, and definitely medical devices form, I would say, at least one investment. If it came your way, you would do it. I mean, I don't know if anybody's going out and saying, I want to do medical devices, but if you get an interesting one, you're definitely going to look at it.
I started investing in health tech companies because somebody told me build a healthy portfolio. Then after a few months, I realized what it means to invest in healthcare. It is a tough space, and devices makes it even more tougher because the whole capex cycle, etc. But we do have companies in the space, lots of learnings. It's tough space all over. Unless you have something really disruptive, which takes its own time to build as well.
To add to Manish's point, there are two segments you can sell to. You can either sell to consumers, you can sell to hospitals. Both are tough and require a lot of money and patience. That is the problem with fundamental problem with medical devices is that either you get to B2C, which is very hard sell, or you get to B2B, where you're selling to hospitals, where you get jacked. That's the fundamental problem we have when we look at this space.
So I think we took a while to get into health tech, med tech space. We studied the sector quite a long time, and we made our first investment about roughly 2 to 3 years back in the cancer diagnosis space. This is a Singapore India company and founded by 2 PhDs actually, a software approach. And then we made second investment very recently, a company called Xyla, which is into this insurance space. But I think it is an interesting sector, but all the things Manish talked about, the regulatory cycles. So we need to make sure our fund cycle is enough, and also the stage we get in actually, because it is very important from a fund point of view when we get into a health tech or a med tech actually, especially med tech with devices, with the regulation cycles and everything. So it's better to get early in the game of the VC fund. Second, actually, we prefer companies has gone through some kind of a regulatory approvals already, right? And but it is an interesting sector, but we need to slowly we have been upping in the game actually. But it has a lot of complexities also, especially on the regulatory aspects actually.
Hi, can you hear me? This is Swadeep here from Blue Ocean Venture Partners. Thank you so much for setting this up, Natarajan, and all of you for coming. This question is specifically for, I guess, Arjun as well as others if they want to add. You mentioned, Arjun, earlier that at a certain point in time, check. At a certain point in time, their companies will be at somewhere between 25 and 50 million revenue. I think I'm losing. Speak loudly. Are you able to hear me now? Yeah, so companies that are in the 25 to $50 million revenue stage, right? You don't know what parameters do you folks look at, is it going to really take off to the next level? Because as Manish said, A is easy, right? And C is easy, you know them. But the ones that are between A and B, something like where you're not sure whether they're going to take off and you should we sell, should we not sell? Those boardroom discussions, what parameters are you looking at? Are there specific certain parameters or some certain metrics, some signs you see in terms of that help you take a better call?
Honestly, somebody else can help me out here because we don't have companies yet at that scale. So, but theoretically, at least, directionally, sort of to get to 20 million plus, you need one product being a super hit, right? And which is selling amazingly well with great pipeline and demand in the market for that particular product through at least a couple of channels, if not more. Also, in my understanding and opinion, by that time, you should have also figured out a second product or feature category, right? Which is sort of, you start with the product number one being your superstar, which is 80% of your revenue. But if you're at 25 million, possibly you should be doing 2 to 5 million, or at least 2 million and above, right? Which is 10%, 15%, 20% from a second product, which is also really starting to explode. Then you're sort of selling two things and both are getting attention, and that gives you the confidence that 20 million will become 60 million and another one will also give you 30, 40 million. You've got to start thinking backward, calculating from what does it take to get to 100 million revenue, correct? So it cannot be a single one-trick pony, if you will, right? You've got to see signals of what other things have started to work. Have you been able to invest in that, which means you set up that 2-3 years before that, and you've got to get early signs of PMF in a second product, by the way, right? It's not easy, right? So you've got to obviously have amazing momentum on one product. You also have early signs of great PMF in a second category. That's my sense of what it should look like, and that momentum should give you confidence that you can absorb a lot of capital to continue growing. But I'll let somebody else chime in if they have, based on their experience.
I guess your question was in terms of exit, whether we should exit at that point or not.
Right. So, do we make a call to sell
or
do we
to stay?
follow on, double down and invest?
It's a hard one, but one simple algorithm we have been using is because we come in early. So by the time the company is in that range, we are almost also close to our funding.
But even 10 to 25 million, not necessarily.
So yeah, even then. So it's a simple decision. If there is an exit, take it.
So I think I'll just add, I think one thing I always look at, in fact we have a common company where we started as a seed and it has grown very nicely to Series C and now it is D, right? We still have substantial stake in the company and we have been making partial exit. I think the one key decision always look at is the founder's quality. Because the founders up to B is not necessarily the same founders needed for C and D. I think in this particular case, I can share the company name called Pixis, where we started in the seed investment. Then we continue to be in Series A, B, C, and still be substantial. We hold equity in the company. I think the quality of the founder taking the company from in India solutions, scaling to the US market, then from US even going into other geographies like LATAM, Middle East, different geographies. I think if I look at the founder quality in the entire 7-year journey process, that gave me the reason not to exit when there were opportunities to exit at, like there was an opportunity to exit at 450 million. Again, there was a recently valuation about 670 million, about 1.5 years back. We did some exit, but not the complete exit. the founder quality convinced, that is one. And I don't think necessarily there has to be a two product. If the solution is powerful enough, there is one more company which we have it in the AI chip space. They have been pursuing the single solution from day one, about 5 years back actually. And I think the market size of that particular solution is making a big difference, because everybody is looking at NVIDIA getting a $4 trillion valuation. But the AI chips, the company which we have invested, is finding relevance because the companies which could not compete with NVIDIA definitely see this company as an alternative solution. So even a single solution can take this company far away. So it doesn't need to be a two solution process or three solution. I think the global market size of the particular disruptiveness, that makes a big difference.
Hi, my name is Rahul from Private Securities, we're the investment bank. My question is for Naganan and anybody else who would like to chip in. So the last point in the panel was about governance, but today we also see a huge emphasis on ESG, which is, so how important do you think is the role of ESG today? I understand you guys come in quite early before the mandatory requirements of ESG taken, but where do you see the landscape going? Since we discussed the G already, if you can talk about ES, and how does it play an active part in your valuations and in the future exits of your portfolio?
At our stage, to be honest, not much at all, right? Because they're still in the process of developing something, and environment is not. But however, there are some companies that address some of those concerns, and when we are looking at it, just say product choices, hardware choices, choose something. And I don't pay any attention to any of that. I mean, governance, yes, because it's important, but other things, very, very little at the stage we come.
So I have a slightly different take on it. It's only because of my bias, which is that having used ESG in larger transactions, I saw that there was value creation. So recognizing that they're young and their attention is all over the place, nonetheless, teaching younger companies good hygiene habits always becomes in a natural. So at least in our portfolios, we insist on not the whole maze, but maybe 2 or 3 goals for each of the categories to aspire towards. Not necessary that you have them on day one, but you consistently go towards that goal regardless of which stage of life you're at.
Hi, my name is Ankit. I'm an advisor. I have a question specific on to my client, which is into EV sector. I have seen in the EV sector, there are few investors, and whoever feedback I'm getting, so it's a very capital intensive, and they don't want to enter into a very early stage kind of thing. So, but I feel, let's say for my client, it's completed a prototype, and they are going into launching the product and completing the MVP part. So let's say for this part only, I'm not getting much traction from the investor. So what is the VC take on that? How do you see?
So I'll take on this one. Basically, we have 2 investments in EV sector. The first one we made about 5 years back into the battery space. The second one we recently invested about 1.5 years back, 2 years back into the EV motors actually. To your question, basically that EV sector, you have to understand the entire economic value chain actually. I mean, any entrepreneur, you have to understand the economic value solution. You have to be very clear whether your solution is going to be sold in India or outside actually. Because the EV solutions, our thesis is, whatever the EV solution for US and Europe is not necessarily applicable for India and Southeast Asia, all the emerging markets. Because US cares about, long range, the charging infrastructure is very good, and the accelerating performance has to be very good. Whereas in India, we look at the cost, basically, right? So I think, basically that we look at whether the entrepreneur has the clarity on the macros, because that's very, very important actually. And so it is not just the product single point solution. That person has to, the entrepreneur has to understand the overall economic value chain. And second, actually, we try to make sure that startups don't get into manufacturing actually. If they go into manufacturing, are they able to bring manufacturing partner? So in the Log9 materials case, Amar Raja became the manufacturing partners. In the second company which we invested, Chara Motors actually, we are in discussion. There is a major three-wheeler company is investing as well as becoming a manufacturing partner. So we facilitate to make sure they have the right partnership actually. Otherwise, startup trying to take too many things will be very, very difficult actually. That's one of the reasons VCs hesitate, because the manufacturing angle is there, hardware angle is there. So the entrepreneur should have the clarity from day one what kind of partnership he is going to have it, or he should ask the VC to help it. So you that answer your question.
So you mean they should outsource the manufacturing?
Either outsourcing, because see, startup actually they may not have the knowledge, manufacturing knowledge. See, what you do in a limited R&D volume is different. What you do in high volume is different. Typically, that comes from established players. That I think I would prefer any investments to have that kind of JV partnership actually, because startup trying to take it is too much actually to handle it.
My only additional 2 cents on that is, if you look at the full stack, which Chinu here is mentioning in the EV landscape, right? Of course, there's the full vehicle, chassis, etc., but there's a motor, there's a controller, then there's a battery pack, right, and a bunch of components. There's a fair bit of competition in every component level already, if you think of what has happened over the last 5 years, right? So depending on what you're doing, that better be very, very differentiated, correct? In terms of either substantial cost reduction or substantial increase in power, which is also very rare, or performance, which is also very specific to which application it is, right? You can have something which is very high powered and great performance, but scooters, three-wheelers don't need that, right? What you need is larger range or faster charging maybe, and most importantly, the cost, right? So that delta, which whatever is the product that you're offering or the component that you're offering, right? They have got into the prototype to see, are there 5 to 10 other people already offering it? You better have a very differentiated solution. At least given that it started about 4 to 5 years ago, if not 6, 7 years ago.
I think just to add to it, any incremental value in this supply chain is not going to cut the ice. So the EV motor we invested, it's called Chara Technologies. Basically, it eliminates the rare material which is used in the magnets. So if you look at the electric motor, it has permanent magnets. That supply chain is completely controlled by China. With all the geopolitical shift, 90% is polluted and it's controlled by China. So this company has come up with a solution which is a combination of software and hardware electronics, which eliminates the need for the permanent magnet coming from China. That's why a lot of OEMs are interested. So I think just to add to the point, it has to be a big disruptor. And it takes time, because probably you have to forego your revenue cycle for the first 2-3 years. But it has to be a very, very big disruptor and should have the global potential also.
Hi. Good evening to the panel. My name is Kushal Devera. I work with Anand Partners. I'm from Mumbai. I had a question on a topic which is not yet discussed. It's on impact financing. I just wanted to ask the panel, how has been the experience when it comes to impact financing? You hear fintech companies coming out with agri-finance kind of models, or fintech companies supporting MSMEs, or fintech companies supporting the climate change model, considering the ESG space. I just wanted to ask, are there any portfolio companies? How has been the experience so far? What has been the traction? Thank you.
So, from an impact perspective, there are companies who are already in the climate space, so let's leave them out. Since you brought up fintech, while one can start at different places in fintech, say that it's MSME, therefore it's impact, it is supply chain of agri, therefore it's impact. But once you gain a certain size, all of those parameters become, while they are there in your DNA, they are less focused on as you want to be able to grow faster. So while there are many companies trying to sort of look after that problem or address it, when it comes to inflection points, then the larger parameters are not so much about, livelihood, impact, supply chain. It is more about, margin, what is your lending rate, how much are you getting equity at, what's your debt equity ratio. That becomes more important, at least in the fintech spaces. The others, climate and all, I think maybe slightly easy to measure, right? GHG emissions, how much is it, and etc. So, but I think it's a very, very, very long way away from becoming sort of mainstream and understood as a separate space.
It's not necessarily hand in hand for us, right? It's not impact first from a mindset perspective. Is there cutting edge tech first and that mindset, right? Like she said, in the hardware side, if you're impacting in energy, sustainability, climate, EV, etc., then you're doing, right? Otherwise, you take the stance of basically as long as it's a high quality business and do no harm is the other angle to take, right? At least invest in businesses that are doing no harm.
Okay, this question is not to anyone in particular, but I just wanted to bring something to the attention of all of you. We are a private equity investor. We are not a VC. Okay, and I always struggle to invest in a company where there is already some other investor on the cap table. This is a company that is scaled up, and most often the struggle is because of valuation. Now, when you look at private equity returns, if you look at the top quartile, you probably are talking of more than 2.5x in terms of returns. The moment it comes below top quartile, you're already coming below 2x. Okay, maybe 2.5x. That's probably where you'll draw the line. So it's not that, the funds like us are being very fussy on valuation and they're not paying. Is there a case where early stage funds are overpaying? And that's probably leading to all of these, because there is a legacy impact on all of this. We often face this issue.
When has the Indian market been underpaid? It's always overvalued. It's not the case of PE versus VC. It's always been like that. What are you saying?
See, Arshna, you being on this side, the side that I am, you know how much we struggle to co-invest or to do a follow-on investment into a company where, there are other people on the cap table. So is there a case? Is there too much prop?
Of course, it's a tough one to say, right? You guys have been in the game much longer. I think it's, from our vantage point, possibly feels that our top quartile companies, deserve a certain, continued venture scale multiples, if you will. Right? I think the question may be true for the middle bucket is either the B bucket that Manish has been referring to. Of course, we don't want to talk about the C bucket, but the B bucket, right, where maybe there can be more meeting of the minds, there's more realistic expectations. But given that this is our primary business, we are wired to keep thinking on venture capital level returns and therefore multiples, correct? And maybe when we are closer to the public markets, we've got to start thinking towards it being closer to private equity multiples and therefore, what it is. I think in the top quartile companies, across again the top quartile funds, etc., VC funds, you will find that the expectations will be fairly heady, if you will, from your vantage point, but realistic and fair from our vantage point. Is the
I think we are all at this stage. You can take your gripe to 15 and Excels of the world.
Kick the ball along. Huh?
I think we'll just take one more question.
My name is Vineet. I run a company called Venture Garage, and we're in the business of investing in advising early stage startups. My question is particularly on the deep tech sector. Only a little while ago, I think the entire ecosystem has gotten very excited that we can build from India for the world. But what I see is that we're not able to even get to bleeding edge technology companies, forget cutting edge. And when I speak to founders, what is the biggest struggle? They say that money is the biggest struggle because the gestation period for building a deep tech company is so high, and there is such little capital available. How do we even get to commercialization? And when you compare it to a US landscape where there is a company like an AST Space Mobile trying to compete with a Starlink, or a Rocket Labs trying to compete with a Space Tech, these companies have been able to raise money from the likes of Vanguard, BlackRock, CONCLAVE Ventures. Not only that, they managed to list on the markets and they're able to raise money from retail investors. So where do you see this landscape going from an Indian ecosystem perspective?
So I think they just started walking in deep tech. Okay? So let's not even get to US. We have no business comparing ourselves with the US. Okay, we just started walking. Let's walk. We'll fund small. We'll build. It will take some decades before we get there. Because our ecosystem, our education system, nothing supports deep tech. I think we all should agree on that and then one step at a time.
I think first hour of day one of a 5-day test match. Correct? That's where we are. Correct? So,
but I think it's a beginning step. I agree with that. But I think, see, our advantage is we have a large diaspora in the US, right? Many of them, actually, I know. See, we invested in 7 PhDs so far. Okay, ranging from Stanford, all these guys. We let them to choose whether they want to set up the company in India or US or Singapore. But I can clearly tell you the product development happens in India. Whether it is treated as a US company or Singapore company, that let the market decide actually. But definitely I see the needle moving. It may be a long journey, but there is a lot of interest to set it up actually. But I think we have to understand other ecosystem. Like for example, many customers, they like to deal with a US setup actually. The thing may get done from here. For example, like one of the AI chip company I mentioned, most of the workforce is in India and Hyderabad. And the founder and some of the guys are in US actually. Okay, the founders, right? But it is treated as a US company, right? So we have to let that journey to take its own path. But I think definitely the needle is moving. That's what I would look at it.
I'll just add one short thing. There is always a difference in macro trend and micro trend. So as a macro trend, okay, you can see if you take 100 companies, there may be 90 of them may be struggling. But you look at 10 examples which are going the other way. That will take time. You can see that happen.
So what you're saying is we have the talent pool available here. Maybe the capital is a challenge as of now, but we'll get there.
Absolutely, there is a clear talent pool available, be it in robotics and in every space. We are able to get global customer. We are not in the scale of US to compare ourselves. We have to be very clear about that. Okay, but we are making the right. We are going in the right direction actually.
That's encouraging. Okay, thank you.
So I think with that, let's conclude this session, and I would request the audience for a round of applause. Thank you so much.
Thank you.
Thank you for the session. I would like the panelists for a quick group photo. With that, we come to the end of the formal proceedings of the day. Thanks once again to our sponsors, speakers and very engaged participants. Please join us for the networking over coffee and tea.
Yes.